All right. Well, welcome. Today is August 14th, and I'm excited to talk today about our seventh webinar of our series, Fundraising Strategy and Process, this time the investor's view. And so I'm really excited to talk today. I'm your host, Jim West, and I'm the Associate Director here at BioTools Innovator. And today, don't know how to stop my video while I'm talking, but today we're joined by Aiden Aceves uh, at Insight Partners, Brad Morey at RCT Research Corporation Technologies, Michael Hansen at Eppendorf Group, and Parissa Kasrapur from Tech Coast Angels, Los Angeles. And before we get going, just as a reminder, this is a 1 hour live stream where we go anybody can tune in and we store this in our archive, and then we'll go into a 30-minute private session Q&A afterwards, just for the cohort. And if you have any questions, please submit them through the Q&A box, not the chat feature, so we can be sure to see and address them. So with that, I'd like to start it off with Aiden. Would you mind introducing yourself?
Sure, happy to, Jim. Thanks for having me today. First of all, I'd like to say my views and opinions are my own and do not represent those of my employer, and none of my comments should be construed to have any representation about Insight Partners' portfolio of companies. My name is Aiden Sevis. I'm a vice president on the Insight Partners investment team, where I focus on investments in therapeutics companies and enabling life sciences technologies, mostly focusing on Series A, seed, as well as slightly later stage investments. I'm also an entrepreneur who previously started a cheminformatics company and a therapeutics company and have a background in protein engineering. Nice to be on with you today.
Thanks, Aiden. Brad, would you like to go next?
Sure. Thanks, Jim, again. I'm Brad Morey. I'm with Research Corporation Technologies, RCT. I've been with them about 5 years. For those of you who don't know who RCT is, we're life science tools investors, also kind of in the seed, Series A, Series B type investment. And we also have some technologies that we license out, and I handle those. That's the Pichia Pastoris expression system, Pichia glycoswitch, and Clear coli, which is endotoxin-free E. coli. And so also about RCT, we also have a medical device side of the house as well as a BioTools investing side. And I guess as far as background goes, I've worked in big pharma, small biotechs, and large and medium-sized CDMOs.
Brad. And then Parissa, would you mind introducing yourself?
Sure. Again, thank you so much for the invite. My name is Parissa Kasrapur. A little bit about my background. I'm a senior executive with 25-year plus experience leading global organizations in medtech, device, and life sciences, both in small, medium, and Fortune 200 companies. I retired actually in 2019, but stay connected with this community, both as an advisor and an investor. I'm currently serving as the president of TCA LA. A little bit about TCA Venture Group, formerly known as Tech Coast Angels. We had some name change. Tech Coast Venture Group is ranked as one of the top angel investing groups in US. We have 5 networks in LA, Pasadena. Meta Angel is part of our organization, Orange County and Inland Empire. We actually added a new group for Southeast, so Florida and Georgia. We have over 400 members. I think so far we've invested since inception about 300 million invested capital. We have invested in over 500 startups, I think about 70 exits. And since 2019, we typically invest somewhere between 40 to 55 deals a year. So a little bit about TCA.
That's a tough retirement.
Well, it's a life. It is. I choose what I want to do, so it's not a bad thing.
Well, that's great. Very active angel group there. Thank you. And we got Michael Hansen.
Yeah, Jim, again, thanks for the invitation to join this panel in this session of your series. I started my professional career as a practicing clinical microbiologist, clinical chemist, working for several laboratory networks, and after a postdoc training, microbiologist, immunologist by background, to an employment sequence starting with Behring Mannheim Corporation, Roche Diagnostics, and Myriad Genetics Laboratories in a variety of roles ranging from an applied R&D lab director to head for corporate business development and licensing. In a succeeding period, I took on responsibilities within the University of Cincinnati's TTO, and then the Cleveland Clinic's innovations and ventures offices, representing those institutions' innovation, commercialization, interest in the life sciences. All those experiences paying forward to an opportunity to join Eppendorf SEs, which has its headquarters in Hamburg, Germany's first try at a corporate venture group. And that arose in Q1 of 2022, continuing today as we transition into a corporate development office. So unlike when in the corporate venture group configuration, responsibility breadth will extend beyond investments. We typically did the Series A, Series B, minority investment, but also will be involved in acquisitions, collaborations, technology, in licensing, and the venture placements in support of all of Eppendorf's various divisions. And like Aidan, I'll go ahead and put a little asterisk saying that my contributions will represent an amalgam of experiences, so not necessarily expressing those specifically of Eppendorf.
Right. Well, thank you all for joining us here today. And I screwed up the screen share. So here is the beautiful slide we have of your guys' intros, which I am showing after your intros. But if anybody wants to remember where you're from, there's the slide. So let's jump into it. The first question I have, it comes from the cohort, and I think it's a pretty good one. And it's just kind of looking at the life science tool space, this landscape. How have you guys seen this area evolving over the last few years, and where do you kind of see it going in terms of your purview and kind of what you see happening in the industry broadly? Brad, maybe we could start with you.
Yeah, sure. So I guess it's taken quite a few turns in the last few years, and I think COVID was part of it. Coming out of COVID was another part. Certainly, we've seen kind of valuations change. From 2021 through 2022, all the way through to today, and so I think that's kind of part of some of the things that are driving the decision making, even on an earlier stage where you're trying to make an investment, early stage about something that could exit later on. And so you have to kind of keep the end in mind as you're starting with the beginning and starting to fund these companies at their very early stages. And I think that's kind of the biggest message and the biggest change that I've seen over the years is that it's as quickly as it kind of went up and became frothy, it's kind of come back down, and there's no more froth left.
Do you see, in terms of you're talking about kind of the changing valuations and things like that, is that an activity sort of tied to what you're seeing in terms of exits in the industry, or how do you kind of see that interacting?
Yeah, I mean, because it's both the numerator and the denominator, you have to think about, right? I mean, I think a lot of companies that are fundraising, or if they're thinking about, okay, the end in mind, if it was easy, if you could get to, it was never easy, but if you can get to 10 million in revenue at a life science tools company in 2021, you might have been thinking that you can exit for 100 million, and then in 2022 you're like, well, maybe I'll take 70, and then in 2023 you might be like, well, I'd take 50, and now we have kind of real world data where a very similar company like that was getting very close to 10 million and was getting offers that were, tranched 40. So it's just very kind of different, changing landscapes in the last 3 years, let's say it that way.
Okay. And Aiden, you also are in a similar sort of space. What do you see?
Yeah, maybe to just really double down on what Brad said here from the other end of usually looking at really early stage investments. I would say that the impetus to show market validation has moved earlier and earlier, whereas previously people would go out and raise rounds somewhat successfully purely for completing technology development activities. These days, almost every funding plan we see, even if it's a pre-seed or a seed, involves some level of market validation, either through early MTAs or partnerships. Really, it seems the onus is on entrepreneurs to prove early on that the market is going to pull through.
Okay, thank you. Parissa, you see the earlier side of things. What are some trends that you've noticed around the industry the last few years and looking forward?
I think nothing to add, based on what Brad and Aiden have mentioned. I think at least I would say that market validation and that option validation, we tend to spend quite a bit on that nowadays as part of our due diligence before making investment and reasonable valuation, knowing that what the potential exit could look like. And also just, I think maybe during pandemic, 2021, it was a little bit crazy from an exit expectation, but before pandemic, I mean, usually it was about maybe 5x your, from an exit, 5x of your EBITDA, maybe at least in my world, and maybe 8 to 10 of revenue, depending on what the company looked like. So I think we're going back to that balance again, I think, at least in my view.
So in terms of you're seeing companies are needing to de-risk their investment for the investors more now than they maybe did a few years ago.
Absolutely.
Yeah. And Michael, what are your thoughts on this?
Yeah, I could be an echo chamber to what's been said by the other three panelists. Of course, with slightly different lenses coming from a corporate point of view. I would agree that for our interests, the investment in a company, be it a collaboration or literally a financial investment, the criteria was moving well upstream, something closer to a product launch. We would also, favor companies that needed funding, but were already taking the first steps to their own commercialization process steps. So was very and is very important to have more than a minimal viable product, something sketched on a whiteboard. Certainly, they have the validations, de-risking involved. We were looking to be less, say, co-development at the point of being a corporate venture group with respect to a switch over to a corporate development group. There might be some further degrees of freedom in servicing our product divisions and their R&D organizations. So that's a little bit of a switch. But I think for the theme of financing, we were seeing a lot of companies that saw the faucet starting to dry up. They were worried about their valuations, didn't want to go through a down round. So proposals, bridge financing, convertible debt safes, were coming up more frequently as, hey, if you're interested, we could see, a vision a little further down the road. We kind of need to go to that next level before we have, for the various reasons others have mentioned, the de-risking, that they really needed more money to take care of before financial and other investors would basically take a bite of the apple.
Right. So Michael, let me ask you, follow up with that. In terms of kind of and maybe you want to speak to your own view or to Eppendorf's view, but have you guys seen your focuses change in terms of like your areas of interest over the last few years? Have they been evolving, or is it pretty sort of not stagnant, but unchanged?
It is anything but static, and that's, I think, a good thing relative to the company did. I think, as Aiden was saying, the COVID years, at least from a tools, somewhat generic supplier of things that people used in labs for any kind of research, were good years for revenue. But in terms of trying to differentiate, the time was really now, since the group was formed, and then moving forward to see where differentiation is going to be important in our world. So our strategies are ever evolving related to what we try to focus on, and that's one of the things that myself, my group, and others within our divisions are very active on, is trying to get the pulse input from the customers as to when we look at our product opportunities. I'm sure Brad does the same thing. What's the workflow? How can we fit in, or what can we do to help them be more efficient, etc. So always fluid.
And I'm sure you all have you're all willing to look at probably any deal in the space, but I am curious, are there any areas that you find particularly interesting or you're more focused on right now, as opposed to others? And if so, would you be willing to share those? And anybody can take that question. Okay, I'll take that as a no. So moving on, when we talk about Brad kind of brought up the idea of lowering valuations, lowering exits, but when you guys look at life science tool companies, do you see differences in this sector that's unique or apart from other sectors surrounding it, or more broadly? Brad, maybe do you have a thought on this?
Yeah, I'm happy to take a first stab at that. I mean, I think kind of what we like about it, I'll just say this, I mean, I think things have changed and it's become a little bit less attractive. But I think hopefully that turns around. But what we like is that you can get to revenue fairly quickly, and then depending on your cost structure, you can probably get to profitability or cash flow positive fairly quickly. And so if you can kind of keep these, what we like to call capital efficient businesses, building and going, if you do have the correct product market fit, you can get your product to market, and then you can, penetrate and drive sales. Then it's really, I mean, all of that is kind of going to de-risk your investment from the investor side, right? Whereas if you're looking at, completely something like a pharmaceutical, you're just dumping money into a hole in the ground and hoping one day it sprouts this money tree. And that's a very different type of investment if you're looking at kind of direct investments into therapeutics, or even some of the kind of more hypey software type or application type plays. So it's just a little bit more of a kind of traditional look at making a business and a viable business that makes money for everyone.
Mm-hmm. Parissa, do you have any views on that?
I guess, we don't have a specific, look at things in that sense, how we distinguish. It's really, the deal and the team and what they're doing. But, we also look, because some of the sort of startups that at least we've seen in this segment, they're starting with the research market, and we really, at the end of the day, will look at the clinical application and how they're going to go there and what it takes to go there, and is it reasonable. I mean, you tend to generate revenue. Potentially you can within the research market because, you know, you don't have the regulatory hurdle and all of that. But then what it takes for you to validate a clinical application, is there one, and what would it take, and sort of the timeline on that? So I don't know if I'm answering your question or not, but you know, that's
Yeah, well,
something that we
you
tend
see a
to.
broad range of companies. You see a lot more
Yeah,
than just license tool companies. So just
yeah.
kind of curious in terms of comparison and contrasting, you know, are there differences you see in terms of sort of these life science focused companies versus more companies in other sectors?
Well, it's very different, right? The timeline is different, the expectation is different, regulatory hurdles are different. So I would say within the life science, we nowadays, especially with the sort of biotech pharma, want to see if there is existing partnership where there is a strategic that's interested, that have sort of are partnering with the company early on in the phase, and then who's leading the round. Is there a lead, right? We're not going to go in if there is no sort of lead in whatever the raise and commitment for the follow-on round. So I think that hurdle for the pharma biotech is a little bit higher. And then for the device and medtech and diagnostic, as I mentioned, it's really their journey from a research into the clinical and what it takes, and you know, the type of data they have. Like, I don't know if I'm answering your question or not, but
Okay.
Yeah, and I think
Yeah, well, yeah, good.
yeah, for us, it's almost like, was that a trick question, Jim? Because given our view, of course, investing in life science tools is a good call because we're a life science tool company. So looking at it slightly differently, that's our answer. But it is something that as the company is looking for what we can do and what we can do better to help our customers, it is important, as others have said, is, you know, what's the trends in the markets and the goals for our customers, which would include academic labs, research only, but more importantly, the biotech pharma. Because, you know, what they're trying to do is going to be at scale. They're going to be under a type of, let's say, scrutiny for performance, accuracy, validation from the regulated environment. We are not a regulated clinical company of any sort. But then things like maybe to your question that you asked previously, you know, cell culturing, cell and gene therapy production, analytics, proteomics, you know, automation of manual procedures, all those kinds of things are within our scope to figure out, can we do it ourselves? If we can't, you know, who has the technology that can help us provide a solution, or, you know, if it's a little bit of a longer game, invest in and then acquire. So, you know, those types of drivers are, you know, what's important.
Great. So to build on that, you know, what I'd like to get into from here is sort of these companies, our companies, these life science companies, as they're building and growing, trying to, you know, optimally optimize for an exit of some form. You know, do you have any sort of thoughts or perspective in terms of what are the most critical factors the company should be focusing on right now to get to that next level of investment or that next M&A activity? Is it total revenue? Is it number or type of customers? Is it market traction? Is it some form of you know, stage of approval? What are your thoughts there? And you know, Aiden, maybe you could kick this one off.
I'm sorry, Jim, I'm not sure if I follow the question.
Sure. For companies that are in the space looking to ultimately, you know, get to that next round of funding or to potentially exit their company, what are the most important value inflections you would look for to signal and to not only to signal, but to maximize the value of their position. Where should they focus? Is it just on the dollar amounts? Is it some other metric in the market, a milestone? What are the things that really turn that nozzle for you guys?
Sure, happy to take this one, although I'm probably the least suited amongst the four of us. I'll just say things we typically look for are primarily revenue, but beyond just revenue, it has to do with the quality of the revenue, which we really think about from the perspective of the chunkiness of it. That is to say, is 90% of your revenue coming from one customer? We see that as a risk. We prefer to see it more evenly spread across accounts. We look at the quality of the logos. That is to say, are these small companies who have their own financing risk, which we're sort of building upon and inheriting by contracting with them, or are these companies like Eppendorf, who are much more stable customers, obviously, if they're buying your product. We also like to think about the patent estate that's being built as well, and the defensibility of the technology. As it increases in visibility, it's going to obviously educate others on a valuable niche in the market, and so continuing to protect and invest in the IP strategy is very important. And so I would say quality of revenue, quality of technology, of course, and the ability to defend it are the key things we're looking for.
Michael, do you want to follow that up?
Yeah, certainly IP at the end of the day, the quality of the team, hopefully they've been successful in getting the financing to get them to the point as the panel had discussed earlier, where it's been de-risked, proof of principle applicability, identified customers, ideally first revenue could be, let's say, attainable. And I think, if you're looking at, is it a company that's focusing on one issue for one customer segment, that would be, certainly more risky than does their technology or product have applicability in a range of customers for them that could be customers for us. That's more attractive. Something on a more, let's say, generic basis. Ran into a number of companies that had, because of, I guess, whatever their pathway or advice they got to get funding, if their cap table was overcomplicated, that was going to be a problem for us to, find our piece of the pie, especially if we're looking, as one would in a corporate venture group, to a positive endpoint being an acquisition. That trying to sort things out like that would just be one of the early red flags that we would say, nope, you're probably going to have some problem, not just with us, but maybe even other investors.
Right. You guys understand your space and market pretty well as well. You've got deep insight there.
Mm-hmm.
Okay. Parisa or Brad, do either of you have anything to add to this section? Okay. So next I want to talk, oh, go ahead. Sorry. Okay. Next I want to talk about kind of company approach and pitch strategy. So you guys, maybe more than anybody else in the room, see a lot of decks and pitches from companies in your day-to-day. I'd love to hear kind of from each of you what your, any sort of like stories you have, experiences you have that were good or bad, what are ways you like to be approached? And then when you're looking through kind of a company's deck and strategy, what are some of the critical things you're looking for within that deck to sort of make a decision to talk it to and continue a conversation with the company? And Brad, maybe we could kick you off with this one.
Yeah, I maybe I should. I don't mean to pick on any, and I'm not going to name names, but I did see one recently where, it's kind of like, okay, we can shorten the cell line development time by, whatever it is, 6 weeks, and if you take Keytruda and it's a $20 billion drug, and then, you equate that into like 6 weeks of sales, and basically, we're worth tens of millions of dollars just for this technology. And so, and that that's a little harsh because, it truly happened, but that's not the kind of thing that like you really want to be pitching. Like, okay, well, let's pick the outlier, let's cherry pick Keytruda, and let's talk about, okay, we could just get your drug to market 6 weeks faster, then you'd have that, the 6 weeks of these massive sales. And realistically, we all understand that like not every drug is going to be a Keytruda or what have you, or multi-billion-dollar drugs. And so I think just a realism, kind of like let's understand what problem we're truly solving, and then kind of you can do the top down analysis, but ultimately bottoms up of like how you're going to approach each individual customer, each segment, how you're going to penetrate into the segments, why they're going to adopt your technology over someone else's. I mean, kind of works a lot better, at least for us, to help understand how this is going to kind of create a complete picture, rather than just saying, oh, this is worth tens of millions because we just saved somebody 6 weeks.
Okay. Parissa, do you want to go next?
Yeah, sure. So I'll answer your second question first. So we get application online, so companies can apply directly online to us. There's a questionnaire they fill, and then it gets screened. And then we have an outreach committee that attends so many pitch competitions. And if they see something they like, they encourage them to apply, or through collaboration with other angel groups or VC. And then, of course, because we are multiple, we have LA has over 120 members. So we constantly attend different events. And, as we see startups, we ask them to apply. But as far as how we look to at least, and we have 2 stages. So you apply, you go through a pre-screening stage, and then if the committee of pre-screening vote you yes, you come to screening. But to get to pre-screening, especially in the sort of what I call life sciences healthcare industry, in no particular order, but we look at the stage of the product, right? Do you have a prototype build? There is validation complete. If it's a sort of a pharma, has the animal studies or preclinical studies have been completed. And then with the exception of the sort of drugs, we like to see at least the commercially, that there is an opportunity to commercially launch the product, about 2-ish years after the funding. And there has been some market validation. And then we look at the market opportunity competition. Does it really solve a problem? Is there a true moat barrier to entry? And of course, we come in early, so the team is very important, the experience of the team and what they've been able to accomplish. And we typically like to see more than just 1 or 2 employees, right? We like to see a team. And their experience, have they gone through past exits, have they startup experience. And while it's not a requirement, we do like to see if there has been non-dilutive funding in the past, because that, I think, also helps validate the technology a little bit, at least for the first round, before we really do a deep dive. I think those were key, high level, to get invited at least to a pre-screening session for us.
Non-dilutive, you mean like SBIRs and
Yeah,
things like that?
yeah,
There's
yeah,
external
grants,
validation
yeah,
on the
yeah,
science and the
definitely.
grants.
It's not a really helps.
Yeah. Okay. And who did I miss? Mike, did we get to you?
No. So on that topic, of course, for us, even though we're a company, and that may in some other companies views want to treat us slightly different, but it is more from an investing standpoint. So anything we get or ask for, should be a non-confidential deck initially. We expect it to be complete, more an extension in detail of what's on a company's website. Of course, the expectation is the company would have done its own due diligence in protecting its IP first, so they can be, basically explaining of who they are, how they got there, what they have. Something that comes up periodically is, exactly what do you want? Is it money? It's also, important for us to hear what's the expectations and reasons for if they've approached us, why us, what do you see as a benefit for working with the Eppendorf Group. Also, I think it was mentioned in part that we need to see any company, this is pretty, let's say, basic advice, clearly explain, why your solution is better and best, but not just say it. It's got to be backed up with data, experiments, things that you might have with posters, papers, things of that nature, should be able to provide that information. And sometimes, a bit surprisingly, companies may come with, okay, we're better, but okay, we don't have competition. Okay, if that's almost a red flag. If a company doesn't think they have competition, they just don't know, the field well enough, and that might be a red flag. So I think it's imperative that you kind of have your own place in the market landscape that you're trying to make a difference in, and then lay it out, why you're better and what features, et cetera. And I think it was another aspect of where to meet, partnering conferences of various sorts, scientific conferences, which are germane to our business. We'll have somebody there to reach out to, and basically have the ability to hopefully, with maybe not so much reliance on LinkedIn, but maybe more direct contact with people, email addresses and that sort of thing, to follow up on meetings and see where the conversation can go next.
Aidan?
Yeah, a lot of really great content here so far. I really agree with the sentiment that it's important for entrepreneurs to know how they fit into the competitive landscape, but also how they fit into the value creation chain. It's very common for us to see entrepreneurs who believe that by providing enabling technology, they capture a disproportionate amount of the value created by the product they ultimately enable. And it's a real non-starter. It reflects a lack of understanding. However, maybe to go to the other topic about how we like to be approached, any which way is fine as long as it's done respectfully and persistently. It's perfectly fine to message a venture capitalist 2-3 times. If they haven't responded, to say politely, hey, have you had a chance to read my email yet? Let me know if you have any comments. Totally fine to do that. Also totally fine to come in through LinkedIn, cold emails. A warm connection is, of course, always best, because when you come in through a warm connection, there's some level of validation from that person who gave us the connection, especially if we have a good relationship. And that also implies a certain level of pre-filtering and screening, because obviously, if you got a warm connection, that person chose to endorse you as opposed to other opportunities they had to pass along. But being respectful is important too. You have to understand when when a funder says no, it's not the right time. It's usually not the time to try to convince them to change their mind on the spot by piling on and telling them why they're wrong and why they really should reconsider. That works about 0% of the time. So just show some grace and come back a few months later, hopefully with a little bit of data incorporating the feedback.
So it's more than just force of personality and getting you to a yes. No means yes. Awesome. Mike, I wanted to go back to you on the competition. I thought that was really interesting. I think we've all heard a lot of people say I have, no or very little competition in this space, but I've always thought someone choosing not to buy my product is also competition. Like, a decision to not buy a product is also something you got to fight against. So in that way, I also think I agree. There's always competition. So that's been great. I think Brad, you were the one. How do you guys prefer to be approached at RCT? Is it kind of like Aidan, or how do people approach you, get in the door, get those conversations started? How do you meet people?
Yeah, I mean, I think a lot similar lines of Aidan. I mean, it's when we get somebody that we know and we trust kind of makes an introduction, that kind of brings another level. I mean, it doesn't mean that they have to necessarily endorse the, like, this is the greatest thing since sliced bread. I mean, they may say that, or they may just say, here's an introduction. But either way, I think it's a pretty good signaling mechanism. And it may just be that, hey, it's not right for their fund at that time, or for wherever their fund is, in their deployment of capital. And it just, they may be very excited about the technology, about the team, about, the IP, what have you, the market. And it's just, so we try to do that for others too. Like if it's just, in fact, I've done that recently. So, passed it along to another life science tools investor where I don't think it was quite a good fit for RCT, but certainly this other investor may decide it's something worth investing in. And then it could be something that RCT looks at in another year or two. And so again, it's kind of, as we keep using the term within the biotools innovator of ecosystem, it really truly is an ecosystem where, we're trying to help companies at different stages where we might not be able to deploy capital necessarily, but we can make those introductions to either other funding sources or strategics or other people that may just help the business.
It sounds like you're saying it's a relationship.
Yeah, I think everything is in this industry as well as many other industries. It's really about just, yeah. And it's like, kind of, echoing some of the other things that were said, just being respectful and, you can push, like you say, if we haven't looked at the slide deck, then by all means, like, push us to kind of take a quick look at it. And then, but once we say, okay, this is a pass for us, revisit it in 6 months. Don't keep piling on the emails. Yeah.
Okay. Well, awesome. One question I have for you guys is in the terms and deals that you guys see, this is just a personal question, I guess, but what percentage of companies that you look at have raised safes in the last year or two?
Happy to go first and just say not a lot. We primarily invest in priced rounds. And so if someone raised a safe in the past year, they're typically not quite ready for us. We do see safes being used the
Oh, no,
most in our
I'm sorry.
portfolio.
My question is when they come to you, how many have raised safes, not are necessarily raising a safe with you? Sorry.
Uh, a good number. Safes are a very common tool we see in the specifically in therapeutics development, where really technology is barely beginning to spin out of academia. And so oftentimes we will see them early in the company's history, but we are primarily priced round investors. So we're not usually looking at them.
Yep. Well,
Marissa?
we're early stage. Yeah, we're early stage. So we usually see post-money saves and convertible notes. I mean, that's what we tend to look at. So I would say 100% of our, have. However, there are some angel groups that don't look at safes anymore and they prefer convertible note. We're not one of them. We look at both, but there are some that. Anyway,
Do you know what the reason for that view is, Marissa?
I don't. I mean, I think I don't. I think they just prefer, just given some of the challenges with the pre-money saves, I think they've decided to go into convertible note. But yeah.
Okay. Well, we do have a question here from the cohort that was submitted, which is when you look at pre-seed companies and they're sort of planning their fundraising strategy, probably with safes, do you guys look at those histories in and the way that they raise those safes? Is that critical? So, for example, maybe one company raised one safe at a number and that got them where they need to go, or maybe another company raised several rounds of safes on smaller amounts. In terms of how they plan that out, batch that process, does that impact your view of the company or potentially them for the future? So should they be thinking about these in one way or another? What are your thoughts on that?
Well, at least for us, when we look at the historical sort of raises where, before they come to us, not only we look at that, and then we look at what's the next stage, what are the next milestones. And I think if we see too many back-to-back raises, I mean, that also indication that, the company is really not clear on what it's needed to give them to a significant milestone, and they're constantly raising money. I don't think that's a good thing. So one of the things we do look at, if you're raising, say, $1 million, to get you to your next milestone, we're hoping that that milestone is at least minimum 12, 18, preferably 24 months out, right? So that you're not, because that is going to give us higher value. It's a critical milestone. It's going to get you to an inflection point. So for us, we want to make sure that they really understand what it takes to get you to that next step in sort of the key business milestones. And if they haven't, that's potentially a red flag for us, because if you're just raising and then you're going to come back 6 months from now and raise another bridge round, right? That's not good.
Right.
So yeah.
Okay.
I don't know if that
Michael,
answered your question or not. Yeah.
Just want to see how you kind of view those differences. Michael, do you have a view on this? Do you guys see rounds kind of coming into the price stage probably?
Yeah, so we would be like what Aiden said, we were only interested in price rounds. If approached for safes, we would say, we're not your right investor. Really, there's no tangibility, for.
So my question is more along the lines of a company with a history of safes. So say they've already raised, the difference being sort of maybe they've had one big safe seed event in their past, or another company has maybe had multiple batches and tranches on a safe before they got to you. Would you view those companies differently, or evaluate them? Would that impact your thought process?
We just haven't had enough data to form an opinion on that. I would echo, and I thank Frieza for sharing her view that, is that a sign for, hey, I'm not even sure what I'm trying to shoot for. And, if we were to look at it, non-dilutive funding's fine. Obviously that makes a lot of sense, but the safes, again, SBIRs, all that sort of stuff are fine, but we just don't have enough data, to form an opinion. Is that good or bad?
Okay. While we're on the safes, do you see much variability among safes? Are there different flavors or things that you've seen, or are they pretty standardized? Parissa, do you want to take this one?
Well, we typically, and many of our applicants have used the Y Combinator post-save template, and we're fine with that. And depending again on the company and the stage and what they're doing, we sometimes add a sort of a sidecar, additional, requirements to it. But other than that, no. I think the template that Y Combinator uses, I think it's used by many startups, at least at the stage that they come to us. So.
Okay. Aiden, do you see any sort of differences in safes? Are there anything about safes that companies could do right or wrong?
There's lots of ways to get things wrong, but maybe to answer the original question, I'll just say that the biggest change we've seen in safes over the last couple of years is it's much more frequent for people to include an MFN clause, which is a most favored nation clause, which is basically a mechanism for ensuring that any subsequent safes that get issued at less favorable terms, you basically have to take those more favorable terms and offer them to previous safe holders. This is a mechanism for protecting from subsequent saves raised back to back at decreasing valuations or more and more investor favorable terms. And it's effectively an anti-dilution protection or some sort of equivalent mechanism for a safe. We're seeing those very, very commonly over the last year and a half, whereas 2-3 years ago, we weren't seeing them at all. And I think it's a reflection of just the increased uncertainty in the markets recently.
Okay. One question that comes in as well is how long does it take your team to make an investment decision around a company and an opportunity? And how long do you kind of know that company before it kind of gets to that stage? Let's see. Michael, do you want to start with this one?
Again, we may be skewing the answers relative to not being a pure financial investor. But I think for us, the closer the fit is to a current search that we have that's relevant to our product divisions, the quicker it will go. We do our own, outbound, if you want to call it that, surveys for the field to try to get to know, who's up and coming in terms of startups in our field, the networking with the financial VC, the incubators, the university tech transfer offices, is how we get to know them. So I would say if it was a cold call to us, you're going to have probably at least a double of whatever and one could come up with in terms of going through the diligence. Is this the best choice for our money? Because we haven't done the landscape to sort of get a feel for who might be in a more privileged position for either an investment partnership or acquisition. We obviously, have to be fiduciarily responsible since either investing from the balance sheet or, doing partnerships or acquisitions. It's not from a fund, it's from, the resources, capital of the company. But those are all timing factors as well. But, in terms of it's on spot on, then, they can go fairly quickly, but I won't venture a time frame.
Okay. Parissa, what about you? You guys being an angel group, you probably have to move pretty fast sometimes.
Yeah, I guess depends on what timeline you look at. If, from an application to a potential due diligence, I would say at least 2, maybe 3 months, because you come in, you pitch, then we have to put you in queue. But if you pitch to at a screening event and we have a vote that, yeah, we want to hear more and sort of put a deal team together that starts the due diligence process, I would say we like to complete it in 4 weeks, but I would, realistically, it's 4 to 8 weeks to complete a due diligence process. We have a standard process, and, once we decide, we provide that questionnaire and the list of documents that we want to see. And we have a deal team, at least minimum, 8 members that are involved that, conduct the due diligence. Yeah.
Brad?
A deal lead and a deal lead. Yeah.
Yeah.
Yeah, I think I would echo those. I mean, ideally, we'd be able to get something done start to finish in 2 months, but I think that's kind of maybe a little bit unrealistic. I mean, if everything was aligned perfectly, yeah, and maybe more like kind of the, like basically what Parissa was saying, like 3 to 4 month time frame is kind of more realistic. I think with RCT, we tend to, some other investors potentially maybe just, throw out an LOI with some sort of, valuation, and then probably maybe it's a high one and they just knock everything down. Whereas we'd rather kind of just research it more thoroughly. Maybe it takes us 6 months to get everything together, and then we put forth not an LOI, but an actual, binding, well, maybe not initially binding, but like, close to what our final offer is going to be. And so, sometimes that creates discrepancies. For example, we're kind of looking at a particular company right now, and they had this LOI for, much higher than what we were looking at to offer. And it's like, well, okay, now, if you want us, to really dig in on everything, we're going to have to, which was what we do just for every single investment, but we're going to look at every single contract that you've signed. We're going to look at all the details of those contracts. We're going to look at, articles of incorporation. We're going to look at IP. We're going to have to go through each of these, with a fine tooth comb, and then, kind of come to our final thoughts. Whereas I think a lot of those things may get done a little bit more on the back end from some companies who may be willing to throw out some just initial LOI.
Great. Do you guys feel like, from the founder's perspective, I feel like you've always got to try to drive a bit of FOMO, a fear of missing out, and you've got to kind of drive some timeliness to a decision. What are some thoughts and strategies you guys have seen that you appreciate or like or think are good ideas for companies that they can kind of help bound the decision making on an investment to get to a yes or a no?
I'm happy to take this one first, Jim. The The first thing to have to say here is communication is key in driving a timely process. You should be checking in with your investors at least once a week, every maybe 10 days if things are moving slow and they've guided you that things are going to take a while. You can always ask people if things are moving positively in diligence, what are the next steps for them? What is their timeline like to hear back? And you can revert to them if you haven't heard from them in that amount of time plus a buffer. Many entrepreneurs will also endeavor to make the process as competitive as possible by syncing up the timing of the fundraising. That is to say, they will start everyone in diligence at the same amount of time, excuse me, at the same point in time. So they'll say, this is the week I'm going to do all of the confidential presentations. This is the week I'm going to aim to do Q&A. This is the week I'm going to aim towards soliciting term sheets and moving towards closing. That only works in the most hot and competitive rounds. You can certainly try that, but if it doesn't work and you're people are moving at their own pace, you should not necessarily try to flex and create FOMO that's unreal because you risk sort of alienating people. If pushed to make a decision quickly that I'm not comfortable to make, the answer is always no. So it's good to create some pressure without sort of forcing people to make an absolute decision unless it's completely authentic and you are about to accept another term sheet.
That's the exact advice I used to get out of timeshare sales talks as well. All right. We got time for maybe one more question here. So just kind of to kind of build on the next stage here. So a company is approaching you and you're interested. The question is, who proposes an initial valuation? And how do you kind of with the company, how does that conversation go, especially people who haven't been through it? Do you kind of ask the company to put a number out first? Do you guys come up with your own number and provide it? What does that process look like? How should companies think through that and maybe prepare for the valuation discussion?
I can just say that for us, as part of your presentation, we need a slide on your deal terms valuation on what you're going to do with the money. We will not consider you if you don't have that slide. Now, we might think you're too expensive, and that's a discussion after we hear more, but we want to understand your deal terms, what you've raised in the past and what's your current valuation.
And even on a safe, you're looking for like a valuation cap or something that sort of lists
yes,
that.
Absolutely. Valuation cap. Yeah, for sure.
Michael, do you have a thought on this?
Yeah, for us, it's almost part and parcel to, how well the company sees themselves in the greater marketplace of where monies can go from investors, corporate, financial, otherwise, to then be able to say, we feel for reasons A, B, C, D to Z, that the raise that we have and valuation we're going to assign to it makes sense. It's clearly important, certainly second and triple Teresa, that what are you going to do with that money? What is it going to be used for? How is it a step to your ultimate view of what the company intends to be? Is it to an exit, to certain partnerships, addressing certain markets? So essentially, we will look for the company approaching us for funding or partnership to basically say what they want. Obviously, we would go in, do our own analysis, but then it's just at that point an exchange of viewpoints. If we're still interested, they're still interested, to then say, okay, can we find that intersection of what are and accept a negotiated endpoint for a term sheet. So they should go first. Yes.
Okay. Brad, Aiden, we got about 1 minute left. Do you guys have any follow-up thoughts on that to close out?
I think it's, usually we often hear the evaluation thrown out, but I mean, it's kind of, it's not going to work as an anchoring technique for us. I mean, we're going to come up with our own valuation based on our own due diligence. And whether you tell me it's 5 million free or 25 million free. I mean, you can tell me anything, but that's not going to matter really.
So how do you guys go about that then? Is there some equations behind it? Do you look at market metrics, comparables? What's the process
Yeah,
there?
but I mean, you can look at comparables, but I mean, the problem is comparables are always, rear facing, right? So if you're looking at comparables from 2021, like then everything looks rosy and we should give everybody, these massive valuations. But if as we see, they kind of come down, steeply to today's terms, and it's like, okay, what, you still don't have the certainty. I mean, you never have certainty on what tomorrow is going to bring, but I mean, uh, comparables are just looking at, at something that may never happen again. It was a past thing, right?
Mm-hmm. Okay. Well, that's the time for our live stream. So thank you everybody for being here.